Most people think Elon Musk is rich because he built great companies. That's true, but it's not the whole story. Because the way Musk actually manages money, how he moves it, risks it, borrows against it, and uses one company to save another, is unlike anything taught in any business school on earth. This is not a biography. You've seen those. This is a breakdown of the financial model behind the most complex personal empire in modern history. And buried inside that model are 5 lessons that apply directly to how you think about money, even if you'll never build a rocket company. Let's get into it. The story starts in 2002. eBay acquires PayPal for $1.5 billion in stock. Musk owned roughly 11.7% of PayPal. His take? Approximately $180 million after taxes. Most people in that position would have stopped, bought a house, maybe a few houses, invested conservatively, lived extremely well for the rest of their lives. Musk did something that most financial advisors would call insane. He took almost all of it and split it between 3 companies he was starting from scratch. $100 million into SpaceX, a rocket company with no customers, no proven technology, and a 90% historical failure rate for new rocket programs. $70 million into Tesla, an electric car company, in 2004, when electric cars were considered a joke, and $10 million into Solar City, a solar energy company founded by his cousins. He kept almost nothing liquid. That decision, to put everything back in rather than protect what he had, is the first and most important financial lesson in the Musk model. Lesson 1. He never confused having money with being safe. 2008 nearly killed everything. SpaceX had launched 3 rockets. All 3 failed. The 4th launch, which Musk has said was funded with money he had borrowed, was the last chance. If it failed, SpaceX was done. It didn't fail, but the company was running on fumes. Meanwhile, Tesla was burning through cash faster than anticipated. The original Roadster was over budget, behind schedule, and the company was weeks away from missing payroll. At the same time, the global financial crisis was making it nearly impossible to raise new investment. Musk was personally broke, not less rich broke, actually broke. He was borrowing money from friends to pay rent. In December 2008, 2 things happened within days of each other. SpaceX won a $1.6 billion NASA contract, its first major government deal, and Tesla closed a funding round, barely, that kept the company alive. Musk later said that 2008 was the year he came closer than anyone knew to losing everything. Lesson 2. Surviving is a strategy. The person who doesn't go bankrupt eventually gets another chance. 10 years later, a different crisis, but just as dangerous. Tesla was trying to scale production of the Model 3. It was supposed to be the car that made Tesla mainstream. Instead, it became what Musk called production hell. The company was losing over $700 million per quarter. Short sellers were betting billions that Tesla would go bankrupt. The stock was being hammered. Musk was sleeping on the factory floor, literally. He later said he didn't leave the Fremont factory for days at a time. And then he sent a tweet: "Am considering taking Tesla private at $420. Funding secured." The stock spiked 11% in minutes, and then the SEC came calling. Musk settled with the SEC for $20 million. He stepped down temporarily as chairman, and the funding secured tweet became one of the most expensive social media posts in history. But here's the financial lesson most people miss from this period. While Tesla was in crisis, Musk never sold his personal Tesla shares to raise cash. He borrowed against them instead. Lesson 3. The ultra-wealthy don't sell assets to get cash. They borrow against them. Because selling triggers taxes, borrowing does not. Here's the part that most financial coverage gets wrong. People talk about Musk's companies as separate entities. Tesla, SpaceX, xAI, the Boring Company, Neuralink. But the financial reality is that they function more like an interconnected ecosystem, where technology, talent, contracts, and capital flow between them in ways that are not always visible. SpaceX develops battery technology. Tesla uses battery technology. SpaceX launches satellites for Starlink. Starlink provides internet connectivity that could power Tesla's autonomous driving network. Tesla's AI chip development feeds into xAI. The companies share engineers, they share supply chains, they share ambitions that reinforce each other. And when one is struggling, Musk has used the strength of another to stabilize it. In 2022, when Musk needed $44 billion to buy Twitter, he sold approximately $15 billion in Tesla stock. And the Tesla share price dropped significantly, costing shareholders hundreds of billions in paper value. His companies are his chess pieces, and he moves them in ways that serve the overall game, not necessarily each individual company's short-term shareholders. Lesson 4. Musk doesn't manage companies, he manages an empire, and the rules of empire management are different from the rules of company management. The Twitter acquisition in 2022 is the most instructive financial case study in recent memory. Musk agreed to buy Twitter for $54.20 per share, $44 billion total. Then he tried to back out. Then Then a court forced him to complete the deal. Here's the financial structure most people don't know. Of the $44 billion, Musk put in approximately $27 billion of his own money, much of it from selling Tesla stock. He raised $7 billion from equity partners including Saudi investors and venture capital firms, and he took on $13 billion in debt, loaded onto Twitter itself, not onto Musk personally. That debt immediately cost Twitter approximately $1 billion per year in interest payments. At the same time, Musk's public behavior drove away major advertisers. Twitter's ad revenue dropped by approximately 50% in the months following the acquisition. The company was renamed X. Its estimated value dropped from $44 billion at purchase to somewhere between $10 billion and $19 billion within 18 months. On paper, Musk lost somewhere between $25 billion and $34 billion on this deal. And yet, he's not worried. Because for Musk, X is not just a social media company. It's the foundation for what he calls the everything app. Payments, banking, identity, communication. A Western version of WeChat. Whether that vision pays off is the $44 billion question. Lesson 5. At Musk's level, individual deals are not evaluated on their own profit and loss. They are evaluated on their strategic position in a larger game. Let's talk about the borrowing model, because this is the mechanism that most people don't understand, and that makes the ultra-wealthy fundamentally different from everyone else. Musk's net worth is mostly Tesla and SpaceX stock, not cash. If he sold that stock to get cash, he would owe capital gains taxes, potentially 20% to 37% on the gains. On billions of dollars, that's hundreds of millions in taxes. Instead, he uses the stock as collateral to borrow cash from banks. The interest on those loans is often tax deductible, and as long as the stock value stays above the loan value, he never has to sell. He never triggers a taxable event. He lives, invests, and acquires companies using borrowed money, backed by appreciating assets. This is legal. It is used by virtually every ultra-wealthy individual in America, and it is one of the primary mechanisms through which extreme wealth compounds without generating significant tax liability. You can't borrow $10 billion against your Tesla stock, but you can understand the principle and apply a version of it. Never sell appreciating assets if you can avoid it. Borrow against them if you need liquidity. Keep compounding. So here are the 5 financial lessons from the Musk model. Lesson 1. Never confuse having money with being safe. Musk put everything back in, every time. That's why the upside was unlimited. Lesson 2. Surviving is a strategy. 2008 should have ended everything. It didn't, because he found a way to stay alive one more day, and then one more. Lesson 3. The wealthy borrow, they don't sell. Selling assets creates taxes. Borrowing against them creates liquidity without the tax event. Lesson 4. Manage the empire, not just the company. The individual deal doesn't matter as much as the overall position. Lesson 5. Individual transactions are strategic moves, not isolated decisions. Twitter losing money doesn't mean the Twitter decision was wrong if it positions something larger correctly. You will never run SpaceX, but you will make financial decisions that involve risk, survival, borrowing, and strategy. And the way you think about those decisions is the difference between building something and just getting by. Here's my honest take on Elon Musk. He is not a template. His risk tolerance is not normal. His resources are not normal. And the consequences of his decisions, good and bad, are not normal. But his financial thinking is a masterclass in how wealth actually compounds at the highest level. Don't copy the man, study the model. So here's the question I want you to sit with. What is the one financial decision you've been avoiding because it felt too risky? Write it in the comments. I read every single one. And if this changed how you think about money, share it with someone who needs a different perspective. I'm Finn, and this is what money is really about. Next week, WeWork. How Adam Neumann built a $47 billion company and watched it collapse to almost zero in 12 months. The most spectacular financial implosion of the decade. Subscribe so you don't miss it.